Welcome to this explainer. Today, we're taking the exact ledger mechanics of the goods and services tax reverse charge mechanism. Yeah, the dreaded GST RCM, and breaking it all down into super clear, actionable steps. If you've ever found yourself completely tangled up in the accounting web of RCM, where you're suddenly playing the role of both the buyer and the tax collector, well, you know keeping those books perfectly aligned feels a bit like a high-wire act. But hey, it really doesn't have to be. We're going to translate all that raw source data of RCM journal entries into a seamless visual journey for you. By the end of this, you'll have a crystal clear map of exactly how to handle these transactions. To keep things incredibly simple, we're going to use a baseline metric today, and that is the number 100. We're going to track this single, straightforward number like it's the main character of a story, right through its entire accounting lifecycle. Honestly, whenever you're trying to wrap your head around a complex ledger mechanism, the absolute best way to do it is to take just one dummy figure and watch how it flows from one account to the next. So, keep your eyes on this 100. To navigate this smoothly, we're going to follow a strict three-part agenda. First, recording the RCM liability. Second, paying that RCM through the bank. And third, using that credit for routine GST. Now, I want you to think of these three steps as a sequence of dominoes. One entry perfectly sets up the next. If you knock the first one down correctly, the second and third are going to fall into place exactly as they should. It's really all about the order of operations here. You literally cannot jump to step 3 without successfully executing steps 1 and 2 first. So let's start setting up our dominoes, shall we? All right, let's dive right into section 1, recording the RCM liability. What's really fascinating here is how a single event elegantly creates both an asset and a mirrored liability at the exact same time. When we record our RCM liability, we're simultaneously acknowledging two different things. First, we're saying, hey, I owe this tax to the government, which is our payable account. But at the exact same time, we're also saying, I'm going to receive a credit for this, which gives birth to our credit receivable account. It's a perfect mirror image. Let's slow down for a second and actually look at the journal entry itself. You can clearly see the symmetry here. Our debit of 100 is perfectly balancing the credit of 100. To record the liability in our books, we debit the RCM Credit Receivable account by our magic number, 100. This recognizes the asset, the future benefit we're going to get, and simultaneously, we credit the RCM Payable account by 100. This recognizes that immediate liability. The scales are perfectly balanced, and boom, our first domino is securely in place. Moving right along to section 2, paying RCM through bank. Okay, so the absolute crucial point right here is that we debit our RCM payable account by 100 to clear out the liability while crediting our bank account by 100 to record the actual physical payment. Remember that RCM payable account we just credited back in step 1? Well, we're neutralizing it right now. By debiting the RCM payable account by 100, that specific liability just vanishes from our books. And of course, because real hard cash is leaving our business to pay the government, we absolutely have to credit our bank account by 100. This actually brilliantly illustrates the exact midpoint of our life cycle. The liability is handled, leaving us with an asset of 100 that is just ready to be deployed. Think about exactly where we stand right now. The payable side of our mirror is gone, it's paid off, zeroed out, which is honestly a rare moment of true accounting zen, right? But the reflection on the other side, that RCM credit receivable of 100 we debited in step 1, it's still just sitting there on our balance sheet. It's an asset, patiently waiting for its big moment to shine.
And that brings us to section 3, using credit for routine GST.
Let's just do a super quick review of the dominoes we've already knocked down before we execute our final, incredibly satisfying journal entry. We established the mirrored accounts at 100. We cleared the RCM payable liability via the bank, and that brings us to our final step, applying the credit receivable against our routine GST liability. Folks, this is the entire point of the reverse charge mechanism from an accounting perspective. You pay it up front, and then you use it to offset your regular tax burden. So on using that RCM credit to pay routine liability, we debit our routine GST payable account by 100, and we credit our RCM credit receivable account by 100. Let's break this down really carefully. You have regular GST that you owe the government from your normal day-to-day operations. That's your routine GST payable. To actually reduce that liability, we debit it by 100. And how are we paying for it? Well, not with the bank this time. No, we're paying for it by crediting that RCM credit receivable account by 100. We are finally cashing in the asset we created all the way back in step 1. By executing this final credit, the last account is zeroed out, bringing the life cycle of our initial 100 to a perfect, neat conclusion. The setup, the payment, and the utilization are totally complete. The RCM credit receivable started with a debit of 100, and it literally just ended with a credit of 100. It's now exactly 0. The narrative of our main character, that trusty number 100, has come to an end. It did its job perfectly without leaving any messy remnants whatsoever in your ledgers. Having followed this exact chronological sequence of journal entries, the most important takeaway for your own books is simply this. Are your RCM ledgers perfectly balanced? Every single time an RCM transaction occurs, it should follow this exact 3-step heartbeat. Record, pay, utilize. If you go look at your own accounts right now, can you trace the domino effect this cleanly? Or do you have orphaned receivables, leaving unclaimed tax credits just sitting on the table? Take these 3 steps, apply them to your own software, and please, don't let a single broken domino cost your business money.